Hello, everyone. We're about to get started. Thanks for coming today and coming to learn about cryptocurrencies. So, if you weren't living under a rock in 2017, you probably heard a lot about cryptocurrencies, either from your friends who wouldn't shut up about it, from the media who around October, November, December seemed to be running stories about Bitcoin and the price surges on almost every channel. And there was a lot of attention. There were captains of industry, Warren Buffett, Jamie Dimon, and a number of individuals giving strong opinions on Bitcoin, on cryptocurrencies, on what was going on. And maybe some friends you knew got involved. Maybe people made a lot of money. Maybe people lost a lot of money because prices come January and February began to drop. But one thing's for sure, Bitcoin and cryptocurrencies captured the attention of the world for several months as the market went through one of the largest growth periods of any asset class that we have seen. And so this obviously sparked a lot of curiosity, and a lot of people got interested. Is this just a scam, another bubble, or is there something more important behind this that is driving the growth and driving the interest? And if cryptocurrencies are legitimate, why do so many respectable people, why do so many educated, smart, capable people seem to be speaking out against them? Well, my aim with this presentation and this class is to give a broad overview of cryptocurrencies and hope that you can walk away understanding a little bit more and having some answers to those questions. So, a little bit about me. My name is Stephen Luca, and I am a cryptocurrency and blockchain consultant. Blockchain is the underlying technology that makes this all possible. I got involved in the sector about a year ago. I had been invested, I had been involved in certain ways prior to that, but I started working professionally in the sector about a year ago. During that time, I have been able to work in a lot of capacities, and that's something I've been really happy about. I've been an advisor to venture capital firms, I've been an advisor to startups, and even ICOs. So an ICO is an initial coin offering, and these are people who are actually in the process of creating and issuing a digital asset. And I call it that because while these all kind of fall under the heading and the name cryptocurrency, in my opinion, it's actually a misnomer. These are not all currencies, and I actually refer to them as digital assets because only a small percentage of what is known as cryptocurrencies actually are currency. Hold on one second. I'm hearing there's some audio interference. I apologize. Give me a moment. Okay. So, sorry about that. As I was saying, a large number of cryptocurrencies have been launched, and most of these would be better classified under the name digital assets. Now, this is because these assets can be used for a variety of purposes besides just the currency function. The cryptocurrencies have launched distributed application platforms where people can program the next generation of apps, and these are decentralized applications. And what that means, and we'll learn a little bit more about that later, is that cryptocurrencies enable applications, enable currency, enable money, enable data exchange that allows these these platforms to operate in a distributed and decentralized fashion. And so they're not run by one central party. They're actually run by a large number of people. And the benefit to that is that there is no way for that single entity, a single controlling entity or a group of companies to issue control over them. And this creates a greater trust. And it's essentially the mission statement that the entire sector has been founded on. So in my time working in the cryptocurrency world, I've actually been able to design blockchain platforms for solutions in a variety of industries, including Internet of Things applications. I've advised ICOs, and so these are people launching their own coins, launching their own applications. And I've helped design the economics of digital cryptocurrency tokens because each of these has a monetary component to it. It has an economic component. So it's this interesting blend between technology, between computer science, and economics. And in my opinion, frankly, it is the most fascinating thing happening. Um, Sorry, I'm being told I still have some audio issues. Give me one moment. I really apologize about that. Okay, sorry about that. Okay, so off to a little bit of a glitchy start with that, but I'm being told most people can hear me fine. So that's a little bit about what has been going on. That's a little bit about me and about the sector. And it's something, like I said, I'm really excited about and I think is really one of the most important innovations. And before we move on, I just one last comment on this is to be involved in the cryptocurrency sector is one of the best moves I feel I've ever made with my life because it's not often you get to be at the edge of something. And cryptocurrencies and blockchain technology are, in a sense, leading the edge. They are moving forward. They are at the edge of innovation. They are at the edge of driving systematic change. And I hope that you walk away from this presentation having learned more about the substance of these digital assets, of cryptocurrencies, and of the technology behind them a little bit, and that I hope it cuts through some of the common misconceptions that a lot of people receive from the media. So here's the game plan for today. Like I said, my goal is to provide a broad introduction to the cryptocurrency world. And so this involves answering the questions like, what are cryptocurrencies? How do they work? Why do they matter? Are these just being used for illegal activities? Why does this have any substance? I'm also going to give an overview of cryptocurrency markets to kind of give you a sense of what is going on that has drawn so much attention and hype, and also how to get involved in the sector as a developer, and also just if you want to get involved. I actually personally I am not a I don't write code. I'm not a programmer, though I have designed the technical infrastructure of these platforms. But so there's actually a lot of ways to work in this that don't require, an explicit computer science background, although there's also plenty of work to do if you have one of those. So the first question is, what is a cryptocurrency? What is this? So in my definition, a cryptocurrency is a decentralized digital asset. and it lives on a distributed network. Now, there's a lot of buzzwords there, and that might not make a whole lot of sense. What this means is that all cryptocurrencies run on a blockchain. A blockchain is a distributed ledger. What does that mean? Think of an Excel spreadsheet that instead of being held by one party that is able to update and change it, it is instead held by thousands and hundreds of thousands of computers all over the world. And in order to make an update on that ledger, all of these computers need to come to an agreement on what the true state of the ledger is. And they have to do this in such a way that they can resist, a single bad entity or even a group of them trying to manipulate it. Now, we'll talk more about that later. But so cryptocurrencies are the assets that are tracked by these ledgers, by these massive Excel spreadsheets with, their protected mechanisms. And so they're really nothing more than numbers on a worldwide spreadsheet. They don't have a physical existence. They're not traditionally backed by anything. One of them it's not worth a unit of gold, or it is not backed by the GDP of some economic organization. They're simply numbers. Now, Bitcoin is the first and largest cryptocurrency, and it's also the most decentralized. It's run by the largest number of people on the largest computer and is accepted and valued in the largest way. It has also the biggest market. Now, cryptocurrency, I talked about how I'm not actually a fan of the phrase cryptocurrency, and that's because it extends far beyond currency. And so people are using this phrase to refer to essentially any digital asset that is run on a blockchain, that is traded on exchanges, and is used for, one of various reasons. It could be digital advertising, smart contracts, it could be tracking supply chains all over the world. And so when people say this, they're really referring to a broad category of digital assets. Now, a lot of people want to know, how do they have value if they're not backed by something, if they're not worth something tangible, and if they're just numbers on a spreadsheet, how in the world can they have value? And the answer is quite simply because people assign value to them, and because these networks create a high degree of certainty that you can trust the results of them. So when people are sending and moving cryptocurrencies on a blockchain, there is a high degree of certainty that the movements, the spending, the receiving of cryptocurrency is valid, and that the source of this blockchain, that the data, that it cannot be manipulated or changed. It would take an extreme event to do so. And so it gives people a degree of certainty in the system, a degree of certainty in their money. And it truly has value, though, because people have looked at this secure system and they have said, this makes good money. And this may be confusing to some people who believe that money is more substantial than it is, but actually this is true of all money. If the paper notes in our pocket, without the societal convention to accept these as currency, they don't have actual utility. They're not useful. Gold, was used as money far outside of its utility in making jewelry or even now electronics. So good money, in the history of money, money is something that is scarce. It's hard to produce, and it's also durable. Ideally, it's divisible, and it's ideally easy to transact with. So Bitcoin and cryptocurrencies actually hit all of these boxes very smoothly. They are usually totally scarce. There is a finite number of them. They are easy to send. They're easy to exchange with. And as they are digital, it's essentially impossible to destroy. You can also lose them. People hear about hacks, and we're going to go over how that happens a little bit later. But they really satisfy all of the conditions of money very smoothly. Now, the other key here is that cryptocurrencies separate for the first time in human history, the ability to issue money from political power. Cryptocurrencies are based on consensus. They're based on a large, distributed, decentralized consensus by hundreds of thousands of nodes of computers all over the world. And this was a grassroots monetary movement. And so all other money is essentially issued by a nation, by a government, which is entrusted with both political and military power. And so the value of the money is essentially backed by the government. And so throughout history and for many people, that makes it, legitimate. That makes it something you can trust. However, it also means that the money is vulnerable to disruptions of that political power, to collapse of the central banking system. And, in the West and in America and in Europe, maybe a little bit less so in Europe, but we have greater certainty that our currency is not going to become devalued overnight. And even quite recently, we've seen Turkey is going through a currency crisis. We've seen Venezuela. We've seen Zimbabwe. And so this is not a certainty. And in fact, there are numerous examples of currencies becoming worthless. So having an alternative to a politically backed currency is not only revolutionary, but it is a good thing for the global economy. And this is what cryptocurrency offers. Another way of looking at that is that cryptocurrencies offer competition in the money sector. They allow different parties to decide to create money, and it's no longer a monopoly run by those with power. So why do we need cryptocurrencies? What are the benefits? Why are these things any good besides what I've already talked about? So first of all, and this kind of ties into the last example, they are a non-sovereign store of value. That means this is money that is not issued by a nation. And like I said, that has certain benefits. But there's other reasons. One of those is machine-to-machine payments. Because these are purely digital, they can be used to allow machines to make payments to each other. Recently, Ford Motors has filed for a patent that allows their cars to have a cryptocurrency wallet. A way to imagine this is that in an autonomous car network where all the cars are self-driving, I could press a button on my car and send micropayments to the cars around me if I needed to pass, if I needed to get somewhere in an emergency. I could also use it to pay tolls or, a number of other things. And that's just one example. And maybe or maybe not, we'll actually see that come to pass. But cryptocurrencies enable efficient machine-to-machine payments. They're also more efficient to send and settle. I work internationally, and I frequently request to be paid in cryptocurrency because I receive it in 10 to 50 minutes. It's fully settled, and it's in my account, and usually for a fee of mere cents. If you've ever tried to wire money internationally and deal with currency conversions, it's much longer and much more expensive. Because of this, cryptocurrencies are also superior for large transfers because the fee that you pay is the same whether you're sending $10 or $10 million. Now, that makes it greater on small amounts of money, but it also makes it the cheapest way to move large sums of money in the entire world. It's an alternative to central bank currencies, which, as discussed previously, creates competition in the money sector, which is a good thing. It allows individuals to have sovereignty over their money because when you own cryptocurrency, you own that for yourself. You control the private keys, which we'll get into later, but it allows someone to actually own their money while storing it securely and not just trust it to a financial institution. Finally, transactions on decentralized networks can't be stopped. Businesses have their transactions essentially stopped or censored through the global banking institutions on a daily basis, and not because they are doing something illegal at all times, not because they are doing something harmful that should be stopped, but because governments decide that a certain industry or a certain country is no longer within their friendly list. And so this has affected people's ability to send money back home overseas, people who leave, nations that are not on good terms with the nation they live in now. And it also has stopped industries such as the emerging, cannabis industry in the United States and many others. So cryptocurrencies allow a non-censorable monetary system. Now, why do we not need cryptocurrencies, and what are some of the common misconceptions? Well, we don't need cryptocurrencies to replace national currencies. Saying that cryptocurrencies are a good thing does not mean that they're going to one day replace the dollar, replace the yen, replace the pound. While this isn't impossible, I don't see this as a considerable trajectory. This isn't one or the other. This is an alternative. Like I said, this is competition. They also don't need to be used for every economic transaction in the world. A future that finds use in cryptocurrencies, it does not need them to become the only means of payment. They also do not need to provide total anonymity. A lot of people think that cryptocurrencies are totally anonymous, but in fact, they're less anonymous than cash. There are a couple specific cryptocurrencies which have specifically optimized for anonymity, but besides those, they're actually more trackable. We also don't need cryptocurrencies to replace cash. It's not a one or the other. It's not a zero-sum game. It's not winner take all. And finally, we don't need cryptocurrencies to facilitate illegal activity. This is a story you hear a lot, that people use Bitcoin for crimes and for just various illegal activities. While that did happen at one time on the Silk Road, which was a popular darknet website, that really was because of the efficiency and the use and some of the benefits that this alternate financial system provided that made it ideal. But nowadays, illegal activity represents less than 1% of Bitcoin transactions. So we need cryptocurrencies to do a few things. As a broad asset class, they are creating a new range of economic activity. They are opening up a lot of doorways. They are creating new forms of economic participation where we are monetizing the digital space in an entirely new way and enabling value transfer over the internet and within systems that provide strong economic incentives. What I mean by this is that cryptocurrency platforms can be used for things like digital advertising that allow the user to get paid when they view ads and allow communication between publishers, advertisers, and users that don't go through a central third party that's taking a cut of all the activity. They enable direct value transfer between those who participate in a platform and the platform itself. Another way of looking at this is imagine if you were rewarded in Facebook stock for the value that you contribute to Facebook. This is the future that cryptocurrencies are moving for. They are moving for economically incentivized, user-owned platforms because they are getting rid of any central party that controls it. Cryptocurrencies are going to provide commodification of the internet and data on a scale previously unseen because of these developments. This is really moving towards the next step of a digital economy. It allows the creation of a true digital economic trust zone, which means that because of the way the technology behind cryptocurrencies worked, it allows tremendous certainty that a given transaction took place. It also allows tremendous certainty that the sender and receiver of money are the correct owner of the account, are actually who, while maybe not who they say they are, but they are the person in control. It is very difficult. Well, it's both easy and difficult to hack cryptocurrencies in the sense of if people leave them unsecured, obviously there are a lot of high profile hacks. But when properly secured, it is one of the most difficult and nigh impenetrable thing to take from someone. And the underlying blockchain platform itself is exceedingly difficult to manipulate. Bitcoin could withstand a full frontal attack from colluding nation states. And to even bother trying to control the Bitcoin network would require tens of billions of dollars and electricity expenditures of the hundreds of millions per day. Cryptocurrencies are in the process of facilitating a greater velocity of economic transactions on a global scale. This is the first truly digital or truly global money. Cryptocurrencies allow people in different countries to exchange money seamlessly. A Bitcoin is a Bitcoin, regardless of what country you're in. You may use a different currency to cash in and out of it, but in a world where Bitcoin becomes more widely accepted, even though it already is in many ways, there is no more cashing out. And so it truly is a digital currency that is global and that is not issued by any controlling party. Cryptocurrencies are also essential to broadly enable smart cities, smart cars, and Internet of Things applications. As our world gets more digital, the need for digital money and distributed economic systems becomes greater. I personally work with a number of companies that are using blockchain technology and cryptocurrencies to enable smart cities and to enable Internet of Things networks. And all of these things work together. With cryptocurrency networks, we can economically incentivize all the various components that go into creating a high-tech world. So, how do cryptocurrencies work? Like I said previously, cryptocurrencies are ledger entries. They're Excel spreadsheets that are deployed all over the world. And so that means they're run on a distributed ledger, as opposed to a centralized ledger, like banks. A bank has a single ledger that they control, and when they move money, they move numbers from one account to another. And that's really all that happens. If you walked into a bank and asked to take a look at the ledger and maybe update a transaction, they would laugh you out. They would tell you to leave. And that's because it's a centralized ledger, and they are the only ones that control it. A centralized ledger has certain vulnerabilities. It's vulnerable to manipulation, whether accidental or malicious. It doesn't mean that someone has to be trying to deliberately benefit or harm others. It could simply be a computer error or an accidental admission. They are also vulnerable to destruction, and centralized ledgers in all of their forms represent a single point of attack that can be taken down, that can be hacked. In fact, banks routinely suffer hacks, and millions of dollars are lost. A decentralized ledger is resistant to those things. It's resistant to corruption, manipulation, or destruction by a single entity or a group of entities. Because if something exists on 500,000 computers all over the world, how will you destroy every copy of it? And if the only way to hack the network is to overpower all of those computers simultaneously, how will you hack it? And how is this possible? This is possible because cryptocurrencies use blockchains that are specifically designed to resist attempts to maliciously attack them. Blockchains are updated by a large number of computers that reach consensus on the state of the ledger at specific intervals. That means that there is a mechanism at work in every blockchain network that allows all of the computers to come to a joint agreement around the state. So if I were to send 10 units of digital currency to someone else on the network, the ledger has to update to reflect that my balance is now 10 units lower and the other person has gained 10 units of currency. However, we have a challenge here because this ledger is not maintained by a single entity that can just edit and move the money. No individual or group in a blockchain or a distributed ledger can make changes on their own. They need the entire network to agree. And so the network uses a consensus mechanism to allow everyone to come to consensus about the true state of the network, even if a portion of the network is lying. Now, that's really key because if we're operating a decentralized ledger, and this is something where no one is in charge of this, no one is maintaining that malicious actors, malicious people that are just trying to benefit themselves are joining the network. And so the network has to be able to work. It has to be able to arrive at the true state of the ledger, despite the presence of individuals who may be seeking to manipulate it, to submit false information, or to otherwise alter the true nature of events. And this is actually a really challenging problem. And it required a solution that built on years, decades of computer science and cryptography and game theory to develop a way to arrive at true consensus, even with a number of parties that are trying to manipulate it. And this is called the Byzantine generals problem. And the first solution to this problem on a large scale was proposed by Satoshi Nakamoto, who is the anonymous founder or founders of Bitcoin. In the original white paper, which was the document released to the internet, Satoshi Nakamoto proposed a mechanism known as proof of work. The goal of this is the ability to reach the true state even while under attack. And today, different cryptocurrencies use different consensus mechanisms. We've evolved away from the original proof of work designed by Satoshi Nakamoto, and now have mechanisms with different names and different ways of operating, such as proof of stake, Byzantine Fault Tolerance, and we even have another network architecture known as directed acyclic graphs. Proof of work requires individuals to guess a number problem. It's the most battle tested, it's the most widely used, it's the only real consensus mechanism that has been in use for at least 10 years and has demonstrated its security. Does that mean it'll always be the gold standard? Maybe, maybe not. There's a lot of different attempts made, and we'll talk about that a little bit. But the way proof of work works is that it requires all of the miners to solve computationally intensive math problems. And these math problems are essentially just brute force guessing, where they need to run a number through a hash. The hash scrambles the number and spits out another number. And they have to do that until they get a specific number. And so miners and the miners who are the people running the proof of work consensus are essentially trying trillions of calculations of this hash until one of them arrives at the correct number. And when they arrive at that, they earn the right to submit the latest block. And so the block is the last update to the ledger. It is the current state of affairs. And a new block is published on Bitcoin every 10 minutes. This system, the proof of work system, creates a lottery system that it costs resources to play. It makes it highly unlikely that a single entity would be able to gain control of ledger updates without controlling over 51% of the computers maintaining the network, which in Bitcoin's case is a billion-dollar affair. Now, if over 51% of the network became controlled by a single entity, they would be able to manipulate the network. But miners, those that maintain the network, have limited ability. They cannot create or destroy Bitcoins. They could not erase our money. They only really have the ability to try to double spend their money, to try to transact, send a unit of Bitcoin, and then try to change the ledger before that transaction has been finalized, which is, it's harmful, and it will certainly, if a 51% attack occurs and some party is able to double spend Bitcoin, they could generate millions and billions of dollars for themselves. But that attack would only be able to be maintained as long as they are willing to shell out, 300 to 500 million of dollars in electricity per day to continue operating the attack. And so it's highly costly, it's highly disincentivized, and it requires immense infrastructure to do. And that is the protection offered by proof of work. Some other mechanisms that I described are proof of stake, which requires users to stake a balance. So say, using Bitcoin, if I were to use proof of stake, I would have to have 1 or 10 Bitcoins, and I would deposit those, and by depositing, I would, gain the right to update the ledger. However, if anything malicious were done, I would lose my stake. And so it's another way of trying to economically incentivize and punish both good actors and bad actors. Mechanisms like Byzantine Fault Tolerance instead try to make the network resistant so that as long as 2/3 of the nodes are honest, the network will arrive at correct consensus, even if 1/3 is trying to deceive the network. All of these different attempts are a good thing. They're innovation in the space. They're trying different solutions to find the best one and to find the best future for these networks, for blockchains, and for digital assets. And we really don't know what the final solution is going to be. We don't really know what's going to be the most efficient one. They all have benefits and drawbacks. And that's really the excitement and the innovation of being involved in cryptocurrency and blockchain at this time. It is something new, and it's something where the answers have not been found yet, and we're currently looking for them. So in summary, cryptocurrencies are digital assets. They're recorded on blockchains, which are decentralized networks, and they're maintained and operated in an open, distributed environment maintained by economic incentives. They exist purely digitally. They move around on these wide networks, and we keep those networks honest by essentially providing money, both incentives and disincentives, to the large number of people who run them. So on a finer level, how do cryptocurrencies work? And what is ownership of a cryptocurrency? In order to own a cryptocurrency, you must control the private key associated with the wallet, which controls those assets on the ledger. A wallet is a program or a physical device which is assigned an alphanumeric code on the blockchain. When cryptocurrencies are transferred to that wallet, the balance updates on the blockchain, and the owner of the private key, you can see this alphanumeric code over in the image, whoever knows that is able to control, to send those assets. There are many types of wallets. There are hardware wallets, which are an actual device which has security features. There's a desktop wallet, which is just a program that runs on your computer. A mobile wallet, which is the same thing but on your phone. A brain wallet, which means you just try to remember that number. And a paper wallet, which is quite literally you write that number down on paper. There's two different types. There are hot wallets, which are connected to the internet and more vulnerable from a security perspective. And there's cold wallets, which are wallets that are not connected to the internet and thus are able to resist attacks. All the assets in a wallet are controlled by the private key. The balance can change, the cryptocurrency can be sent. The private key must always be kept secret. However, in order to send something on an open network, there needs to be some way that I can confirm to the network that I am the real owner of this private key. Otherwise, anyone could send any balance. However, if that private key were to be revealed, anyone could take my money. And so cryptocurrencies use a public key cryptography system where there is a private key, and through a cryptographic digital algorithm, a cryptography scheme, the public key is arrived at. So each public key is generated from the private key. The private key, as its name suggests, is kept private by their owner, but the public key is used to interact with the network. So when I send a transaction, I sign that transaction. I generate a signature by using my public key and a hashing function to create, or I use my private key and a hashing function to create a hash. And I send that out to the network. And then the recipient must go and they will decrypt the hash using my public key, which is available. And if my public key decrypts the message, then they can know that that message was created using my private key. I have now proved ownership of my private key to them without revealing it. And that's the benefit of using this public cryptography system for an open network. It's virtually impossible to guess a private key given a public key. Private keys are generated using elliptical curve cryptography, and it's a sophisticated scheme which plots points on a hypermassive mathematical plot and essentially randomly shuffles them around, exponentially huge numbers of times, and basically just arrives at a random other point on the graph. Essentially, what this means is that to try to guess a private key, you would have to run even an advanced computer network for millions of years to even try to get one. And so while it's not impossible, it's completely unlikely and infeasible. People commonly store their cryptocurrency on exchanges, which essentially means they are not storing it in a wallet. This is a risk because not only do you not truly own that crypto unless you control the private key, and therefore the wallet and address where it is stored, but exchanges can have security vulnerabilities and your funds can be lost. A lot of the hacking that you hear are exchanges getting hacked and people losing the money held on them. One of the most well-known ones was the Mt. Gox hack. Mt. Gox was a Magic the Gathering trading website that essentially turned into a Bitcoin trading marketplace, and it went down in flames several years ago with all of the funds being lost. And those funds are there's still a legal trial going on trying to return that money to the users. So that's a broad overview of what cryptocurrencies are, how they work, some of the technology involved. Now, let's talk about the markets. The markets are, I would say, the thing that catches most people's attention more than the technology. Most people don't really know a whole lot about the technology, but they know a lot about the price. So I mentioned exchanges before. There's a wide number of cryptocurrency exchanges that to this day now trade hundreds of assets. We obviously saw in 1 year, in 2017, the price of Bitcoin went from $1,000 to $20,000. It was the biggest gainer for that year. That was the best investment you could have made. And actually, Bitcoin is the single best investment that anyone could have made in all of human history. There is nothing in our entire history that has ever returned more money to investors than Bitcoin. And so Bitcoin went 20x last year. Other cryptocurrencies perhaps went even more. This is largely what drew the attention to the sector. So what's going on here? Cryptocurrencies are currently operating in a series of Gartner Hype Cycles. This is a theory that explains how early stage technology goes through cycles. Essentially, what you see is there are cycles of euphoria where people feel this is a new paradigm, this is going to change the world. They invest large sums of money, they buy the assets, and then inevitably, that when those expectations don't plan out because they're not really rooted in the current reality of the technology, there is in the theory, it's called a trough of disappointment. And so the prices, they bottom out, they lower, and then during that time, there is a gradual return to a more realistic price before the next cycle starts again, and the next cycle of euphoria begins again. Cryptocurrencies have been operating in these waves since their inception. We have seen several major bubbles. And so a bubble I'm just defining as a parabolic increase in price that later drops almost 80% of its gain. And yet, over the long term, it's done nothing but consistently increase. Now, don't take that to mean you should run out and go put everything you own in Bitcoin or other cryptocurrencies, because as you've seen, people have both made and lost huge sums of money. But it is to say that there is a long-term trend, and it's been the best trend in human history for an investor. Why are cryptocurrencies so volatile? The price, it goes up, it goes down. I talked about how, there is this theory operating here. But it's even more so than that. That's because the value of cryptocurrencies is almost entirely based on individual people today, what they think people in the future will value these things. The Bitcoin investor is buying Bitcoin because they think people in 10 years are going to be using Bitcoin. And the value of what they think those people will assign to the Bitcoin is just speculation on speculation. And this leads that the markets to be highly volatile. And like I said, they go through parabolic increases and intense crashes. The liquidity of cryptocurrency markets is highly limited and can be easily manipulated because of that. Liquidity in this sense means the robustness of the market, how easy it is to buy and sell a given quantity. In traditional equity markets, in the stock market and with assets, individuals can sell millions and billions of dollars of shares without undue influence, impact. Obviously, it changes the market to a certain degree, but in the cryptocurrency world, some of the minor cryptocurrency assets could be dropped by a single $1 million sale, and the larger assets like Bitcoin can still be significantly manipulated with just a couple $1 million. This is insignificant in comparison to traditional capital markets. And so the liquidity has led to a lot of manipulation and a lot of market dynamics which don't emerge in a mature market. The cryptocurrency ecosystem is also heavily reliant on exchanges, platforms where users can buy and sell cryptocurrencies. Exchanges may or may not offer services for fiat currency being traditional government currency. Some of them are Bitcoin only, and so Bitcoin is the only way to buy or sell. And so you actually see it operating as a base currency pair, which is really fascinating to people examining it for the first time and for people who've been in it for years, that Bitcoin actually operates as the primary medium of exchange to buy other cryptocurrencies, and it does an incredible job. Some of these exchanges offer hundreds of assets. Main ones like Coinbase maybe offer 5. Coinbase, their main claim to fame is that you can hook your bank account up to it. And that's a very useful feature and has led to a lot of onboarding into the ecosystem. It's allowed the average buyer to move money in. And maybe they're happy about that, and maybe they're not, depending on if they bought in August or they bought in November. But as you move away from Bitcoin and the major exchanges, the markets become increasingly illiquid, increasingly manipulated. And what that means is they are extremely immature. One day that might change. We're currently seeing NASDAQ and the New York Stock Exchange and major financial institutions are having meetings and actually working to try to improve not just the image of cryptocurrency, but they're also building platforms to allow for institutional engagement in the cryptocurrency sector. So it's the mature market is coming, but it is not here yet. From a legal and a regulatory perspective, the cryptocurrency market is in an interesting situation. Currently, regulation is extremely uncertain. Most national governments have yet to put forward concrete regulations. There's some, and the SEC and the United States has been relatively friendly, but as an industry, we're still waiting on that sort of final decision. And it's not really supporting the ecosystem. We want that regulation. It'll give companies a lot of clarity. It'll let us move. It'll let us make decisions in a much simpler fashion. So, contrary to popular belief, cryptocurrencies are not a hub for illegal activity. They are not primarily used by criminals. They are not funding, huge degrees of money laundering or drug smuggling. There are, of course, to a certain extent that is going on, but that happens with all money. Money is used for economic transactions, and cryptocurrencies are no more guilty of this than cash. The legislation is challenging, however. It's very difficult for countries and for nations to propose efficient legislation. One, because it's not really deeply understood yet. And the other is that this is a global phenomenon, and there really is no way for a government to issue tight control on it. They can, of course, shut down exchanges, make it illegal, they can interfere greatly. And yet, it could still be accessed, and the transactions really cannot be stopped at all. So it is a global phenomena that is very difficult to control, and thus it really will take a coordinated global effort to arrive at any sort of really concrete regulation. Obviously, individual nations are providing their own jurisdiction. On a regulatory level, China has the harshest regulation. They have banned it many times, although this doesn't mean that they aren't moving forward in certain ways. The US has been highly friendly. They essentially are, the US is historically highly open to innovation. They, had the hands-off laws that helped the internet develop, and they're really taking a wait and see approach. And that's really great. We need a more concrete decision right now, but they've been wonderful. The most crypto-friendly jurisdictions, though, are Malta, the Cayman Islands, and other islands that have really led the charge and are pushing for, they are creating laws, they are pushing for it, they are giving companies regulatory certainty. Most companies I work with have incorporated in Malta. Also, Estonia has been a good company or a good country for crypto. Some states currently allow taxes to be paid in cryptocurrency, which is honestly a huge deal, and counties, really all over the United States, they are popping up. Laws and taxes are really coming on the books soon. So on a global level, what does this look like? I'm from the US. I imagine some of you might be listening from all over the world, and that's good because cryptocurrencies are a global phenomenon. There's a huge amount of activity all over the world. Unlike Silicon Valley and other hubs which have really obtained a geographic location, cryptocurrencies have been distributed everywhere. There's activity happening everywhere. And in fact, they're even bigger in countries outside of America and Europe. The Asian markets are much larger than the Western markets. Many African countries are showing strong interest in cryptocurrencies. Cryptocurrencies have even been declared halal under Islam, which is an important religious support, which affects the ability of Islamic individuals to invest. As I said, China is staunchly opposed, but they have actually been developing their own crypto assets. They are trialing a central bank controlled crypto and also really pushing for blockchain research. They're also home to several major cryptocurrency projects, and they have not banned the innovation and the operation. They just do not allow their citizens to trade, purchase, or invest in cryptocurrencies. They have removed exchanges. And yet still, the Chinese have been a large investor, and some of the biggest cryptocurrency companies in the world are there. The largest Bitcoin miner in the world is Bitmain, and the Neo ecosystem, along with Ontology, is building a corporate blockchain structure for China. Venezuela has issued its own cryptocurrency, which, in my opinion, is a total fraud. And other countries are considering issuing one. This is a recent event, and this is something that I think is incredibly important, but during Turkey's ongoing and current currency crisis, something changed. Normally, when a country's currency is in trouble, people take the money and they buy gold, and it's a way that they hedge themselves against the devaluation of their currency. But that didn't happen this time, and that's the first time in human history. During the currency crisis, gold dropped. It dropped significantly. It went down, even though that's the time when most people should buy. And what happened was Bitcoin volumes in Turkey surged over 50%. If this becomes a trend that in times of fiat money destabilization, money moves into Bitcoin, it will become an economic pattern that cannot be ignored and will have to be included not just in the global markets of the world, but in the textbooks. So how do you get involved in crypto? It's a rapidly developing and highly funded sector. Its innovation is only matched by how much money is in it. There are a huge number of developer and non-developer positions available. You can work in marketing, you can work in management of these companies on an idea level, you can work as a educator, and many other positions. For every single developer who knows how to work with blockchain and cryptocurrencies, there are 14 open jobs. These jobs pay extremely well, in the 130,000 plus for new people. There's huge demand for these jobs. They can't be filled fast enough. It is, if you're a developer that wants to learn how to work with these systems, that's looking for work, it is a very easy, high demand sector to have someone who wants you to work on their blockchain or on their smart contracts. And like I just said, blockchain development works mainly with smart contracts. Smart contracts are simply programs that run on a blockchain. Smart contract program is not hugely different from normal programming. It may use a different programming language, but you're essentially just writing a traditional thing that just uses the blockchain. There is one major difference, however. The smart contract must be flawless when you upload it to the network. Once they are live, they cannot be altered in any way, and a single error could allow millions of dollars to be lost. This is a major challenge for developers in the sector, and hopefully it's something that we will be able to find some creative solution for, but there are reasons why it's highly important that these things cannot be changed. It would not allow the same level of trust if the code could simply be altered. Blockchain and cryptocurrency developers are only going to be in more and more demand over the coming decade, and I would imagine it's going to be the fastest growing developer job market in the world. Maybe, there are also, not to diminish the impact of AI and other technologies that are coming online, but this is going to be a big one. Maybe not the biggest, but a large one. As an aspiring developer, there's many things you can do. Most projects offer developer bounties where you can receive payment in cryptocurrency for identifying flaws in the project's code. And like I said, there are additionally thousands of projects and companies that are looking to hire new developers. You could work for an ICO, an existing cryptocurrency project. You can work for an exchange, a third-party services company like a wallet provider, or even for IBM, who has a massive blockchain division and has funneled hundreds of millions of dollars into building Hyperledger and even working with certain decentralized cryptocurrencies like Stellar Lumens. Blockchain hackathons are frequently held. Developer co-working spaces such as block spaces exist, and one can typically contact the project dev teams on Telegram. Performing a small fix or task on a project's GitHub can be a good way to introduce yourself and demonstrate your skills. Also, if you're looking to get involved and learn more, I highly recommend the book Mastering Bitcoin by Andreas Antonopoulos for any aspiring blockchain developer. And there are a number of books on the subject, including Mastering Ethereum, Guides to the Solidity coding language, and others. And for those who are not interested from a developer's perspective, reach out to these companies, reach out to exchanges, reach out to investment funds. There's both the technology and the economic aspect. There's writers, publishers, advertisers, project managers. There's a lot to do, and it carries the excitement of working in one of the fastest developing sectors in the world right now. So that about finishes my presentation here. I just want to announce that GPAL will be offering an SQL class next Sunday at 5:30, and here's the link to sign up. It'll also be available in the Discord. So come check this out if you want to learn a little bit more about SQL. And I just want to say thank you. Again, my name is Steven Lupka. I'm a cryptocurrency and blockchain consultant. I'm actually going to be hosting an Ask Me Anything after the presentation on the Discord. So come over to Let's Learn, and I'm going to be sitting down to talk with you guys, while you have questions. And I'd really love to answer any of your questions or talk more. Also, if you ever want to contact me in the future, you can reach me at my email, blockchaininnovations@gmail.com, and you could also add me on LinkedIn at Crypto Capital Services. Thank you.